If you look at the markets yesterday, it did appear as though some investors were positioning ahead of this jobs print for that possibility. I mean, you saw big tech names selling off, the Nasdaq off 1%, leading the way lower, the dollar gaining strength. So not a huge move, but it does appear as though some people want to hedge in case this could point to a more hawkish Fed. Is that something you would advise? How are you handling this risk in your portfolio?
Right. So Nancy, from my point of view, I think that is a lower risk. Remember, we go back to thinking about Fed's dual mandate. So far everyone's been focused on inflation, markets obsessing about inflation numbers, and really testing the notion that do we think it's transient or more persistent. Strong reports in job market is also another focus for the Fed, because they have stated again and again that it's not just inflation, but they're also looking to see very broad participation in the labor market. They're looking for full employment. So my expectation is that even if we see strong labor market data this month and next few months, I think we are still around 8 to 10 million jobs away from what would be considered a very healthy state of the labor market. So this reaction, in the bond market is probably legitimate because inflation is here. But the dollar strength was a little surprising, and I think that is a little premature to think of a hawkish stance this early. My perspective is they're going to stay very patient.
What about your portfolio strategy at a time like this? I'm looking at your notes, and you have downgraded U.S. credit, securitized, and TIPS, which is seen as a favorite inflation hedge vehicle.
That's right. I think TIPS are pricing in a pretty rosy scenario, Tanvir. And most of the other credit spreads that you mentioned, all those areas look fairly richly valued. So from our perspective, I think it's better to take opportunities elsewhere other than US credit markets. And even to some extent, US equity markets look fairly rich to us. For us, there is a lot more opportunity right now in developed equities and also in emerging markets. Those are the two areas that we are adding to while we downgrade US markets generally.